Hey everyone, hope you're all enjoying your summer and staying healthy.
Hard to believe we're already in the second half of 2021. Welcome to our Midyear Outlook, and in this video we're going to touch on the economy, policy, stocks and bonds.
Stay tuned.
Last year it was a year in which it was very painful while the market was declining. We were pretty constant with what our recommendation was, which was to stay the course. Some of you actually added money, but we did not want people coming out of the market. We said all it will take is some good news to turn this market around. You have to understand that the bar was set so low with what was going on with the pandemic. If we just take a little news to bring things to a turnaround. So what did we see? We saw news about the vaccine, and then all of a sudden it trickled to other areas, and we started getting a little bit positive news on the economic front, and then the Fed did a lot as well. So there was a lot of good news, and then we take a look at where we are today, where the markets are hitting new highs. It changes every day, but for the most part, the market has really come back strongly. Those of you who stayed the course, congratulations, it paid off. Also want to talk about the economy and then policy before Jim gets into stocks and bonds. But when we look at the economy, first thing I would say is we're just about a year into this expansion. The official data isn't out yet, but give or take a month or a few weeks, that's where we're at. It's been one of the best years we've had in many, many years. In fact, growth in the U.S., it's going to probably come in this year somewhere at 6 3/4 or maybe even a little higher. If that's the case, it'll be the best year we've had since 1984. LPL Research actually believes it might even come in a little higher, maybe closer to 7. If that's the case, 7% of gross domestic production, GDP. That would bring us out to the best economy that we've had since the early 1950s. So here is one thing we would say. The average expansion has lasted 5 years if you go back to the 50s. We are 1 year into this expansion, and we don't believe that there's any reason to believe that the party is over. We believe it may not be the average of 5 years or longer, but it certainly could be another few years. The expansion that led right up to the pandemic was 10 years. So, we're overall positive on the economy. So if we take a look at policy, there's two policies we need to look at. Monetary, which is set by the Federal Reserve, and then fiscal, which is set by the government in terms of taxing, spending, stimulus, those things. So if you take a look at monetary policy, interest rates, as we know, are still incredibly low. In fact, as of this recording, the 10-year bond now has dropped to under 1.2%. It had gone up to 1.75% earlier this year, when there really was a huge inflation scare. But rates are really low. Yes, they probably will move up, but we think where we're at is a real tailwind for the stock market. The Fed and Jay Powell, they're the most transparent Federal Reserve we've ever had, and they continually tell us that they're not going to raise interest rates probably for at least another year. If we take a look at the fiscal, by the way, they're also buying long-term bonds. So all of this is really positive. And you've heard the saying, don't fight the Fed. Well, as long as the Fed is accommodating, it's going to be good for stocks. Now, when we look at the fiscal policy, right now, they're saying we're spending about 6 times the amount in stimulus that we spent during the financial crisis of 2008. I mean, that is remarkable. That's such a large amount of money, you can't even put your arms around it. So far it's been about 5 trillion in the second half of the year, with the infrastructure bill and then the other, bill that they're going to try to package together. It might be 2 or 3 trillion more. So these are tailwinds. Now we do get a lot of questions about the debt that we're racking up, and people are very scared. And many will say we should probably get out of the market because of this debt. And what we've said, and we'll continue to say, is that some things are out of our control. We're almost at $30 trillion in debt. I mean, that's out of our control. Is it going to be bad? You would think unless we do something, it's not going to be good. But it may take 10 or 20 years to really experience the problems of having that much debt. And who knows? Conventional wisdom says it's a problem. Conventional wisdom in the last 10 years has been wrong. Maybe it's not going to be a problem. But regardless, we say focus on the next few years. Even if you have a long-term time horizon, let's look at the next 2 or 3 years. And we don't think the debt is going to be a problem in the next, in the near term. So therefore, we think all of this stimulus is really positive for stocks. If we take a look at, the economy is really doing well, as I said. It's speeding along. Sometimes when you go a little too fast, you can get into an accident. So, that's one thing we're cautious about. But we are positive. And then the monetary and the fiscal policy that's in place are tailwinds. We think these are the things that'll keep the market and the economy moving forward. So with that said, I'm going to turn over to Jim. He'll comment on the stock and bond market.
So turning now to stocks, and we're entering into the second year of this bull market. And historically speaking, a second year of a bull market is more challenging than the first, with more volatility, but still tends to produce gains in the equities markets. And a lot of that comes down to the improving economy. Jim Sr. talked about it, how far we've come in 1 year. When it comes down to it, we see a much stronger consumer now, more dollars in the consumer's pockets. So those dollars get circulated in the economy. More transactions, more purchases of goods and services, which drives up GDP. Typically is good for the earnings of these underlying companies that make up the stock market, that make up the S&P 500. So far, earnings have been very strong. Q1 was phenomenal. Q2 was also very strong. So we are seeing pretty strong fundamentals. And although valuations now are becoming elevated, we feel they are supported through a low interest rate environment, as well as continued earnings growth potential as we continue along in the economic cycle. And we figured that 2021 would be a strong year for the equities markets. We were a little bit surprised by just how strong it has been, especially coming off a roughly 16% gain in the S&P in 2020, a 29% gain in the S&P 500 in 2019. So we've been optimistic about the market. We continue to be optimistic about the market, but it is very important to acknowledge that we have not seen that volatility that oftentimes you encounter in the second year of a bull market. We have not had a 5% correction since last October. That typically happens 2 or 3 times per year. So as we approach historically more troublesome months in the market, August, September, October, we could see a pullback here. That said, it's not necessarily a bad thing. Oftentimes, when the market levels off or takes a break from its upward push, sometimes that's needed for that next leg, the next leg upward. So overall, we're optimistic about the market, but we do acknowledge that we have not seen a whole lot of volatility as of recent, and that is certainly something that we can expect going forward. So now onto the bond market, and we've seen 2 major surprises with interest rates so far in 2021. To start this year, it was our expectations that the 10-year Treasury yield would steadily rise throughout the year. And in Q1, that rise took place. However, the strength of the move upward caught a lot of investors off guard. Even more surprising was the reversal of that move, which came in March. And for the last 4 months, we've seen that 10-year Treasury yield continue to fall. Now, there's not a simple explanation for why rates are moving lower. A couple important variables to note would be the initial outsized expectations of rising inflation, short covering for crowded bets on rates to move higher, foreign buying, and uncertainty around the Delta variant and consequences of the COVID situation that we find ourselves in currently. And it also may have just been a case of rates rising too far, too fast towards the end of 2020 and then the beginning of 2021. So a correction certainly took place, albeit one that was stronger than many analysts saw coming. So where does that leave us? Looking out for the rest of 2021, despite 4 months of falling interest rates, growth and inflation expectations point to most likely to rates moving upward at some point in the next several months. And that would probably be our view as well. And it's important to remember we are still in an environment of rates moving higher. The 10-year Treasury note is higher than it was to start this year. And we wouldn't be surprised if that continued in 2021. Well, that wraps up our 2021 Mid-Year Market Outlook.
Thanks for listening, and if you have any questions, please give us a call.
Thanks again, everyone. Take care.